Last but not least, I want to talk about nickel, and nickel's been a very curious one, and unfortunately a little bit of a broken one in terms of its market conditions over the last 9 to 12 months. You can see it somewhat here within this chart, although it's absolutely dwarfed by what happened back in March. But we, at least from my perspective, saw another short squeeze in the nickel market. In about 2 weeks, from late October to mid-November, we saw nickel prices jump 43%. Now, did anything fundamental change that would suggest that prices should go up 43%? No. There were some rumors that there was a fire or an explosion at a small nickel facility in New Caledonia, but does that warrant a 43% move in nickel when you've got plenty of class 2 nickel, nickel pig iron, nickel matte, things like that? I would say no. But what you do have is a scenario whereby a large amount of the trading community and those who participate in the nickel market have basically left. So whether that's a bank, whether that's a market maker, or hedge funds, consumers, whatever it is, 34% of trading volume has basically left the market, said we're not going to touch this product, all because of that nickel short squeeze that happened back in March. And when traders leave markets, it tends to cause larger gaps in buyers and sellers. It tends to allow a little bit more gamesmanship, and it just allows fewer players to kind of push things around. And I would say that's kind of what we're seeing. I know that might sound a little conspiratorial, but you can see it pretty evidently here. A large percentage of the market has left, and they have not come back yet. Will they come back? Maybe they will, and they'll add more liquidity, and you'll be able to buy and sell positions with more ease. But right now, unfortunately, the smallest headlines and the smallest bit of momentum can cause people to panic a bit. And like, for instance, from what I understand, when this squeeze happened, that happened back in early November, from what I understand, it all occurred based on about 2,000 contracts in nickel, which is maybe, I'm just doing quick math in my head, might be $20 to $30 million worth of nickel, that's a lot of nickel, but $20 to $30 million worth of nickel on a global basis really isn't that big of a trade. But from what I understand, it was that type of size that moved the market by 45%, which impacts billions and billions of dollars of physical metal transactions. That shouldn't typically happen in a normal functioning market. So it's something we have to deal with. It's something we're going to get through. I tend to think clear heads will prevail, and the good news is short squeezes tend to be short-lived. Maybe that's part of their name, but one anecdote that I found very interesting earlier this week, back in the short squeeze in March, I think we had talked about the idea that there were very, very large margin calls. The margin call basically being that if somebody was short, or in other words, betting on the market to go down, when the market goes up and up and up, they've obviously got losses on their financial position. It was estimated back then, and I remember talking about this on A Cup of Joe, it was estimated that those losses were somewhere around $10 to $15 billion, billion with a B, and that those numbers were on the brink of bringing the London Metal Exchange to its knees, or perhaps worse, bringing some of these banks to their knees in a way. And that was why they shut down the market, canceled trading, canceled a bunch of the contracts. Well, fast forward to this week, I saw one headline. I haven't seen it corroborated too many other places, but I saw a headline suggesting that the London Metal Exchange came out and said that those margin calls were actually $20 billion. So even larger than what we had speculated. And I think the vast majority of that was with one entity who was short the market. So $20 billion, I don't know about you, but that's a lot of money to come up with in a fairly short fashion. And that explains why things got so turbulent. And that explains why so many have left the market and said, I don't want to play here anymore. This is scary. Again, I do think clear heads prevail. I do think that this will sort itself out, but it's going to take some time, and the market's definitely got its bumps and bruises right now. And then last but not least, LME nickel. I know we talked about this last month, but I just want to reiterate the idea that when we look at nickel being all forms of nickel, class 1 and class 2 and various secondary forms of nickel, there is a lot of nickel out in the world. So the market is well supplied to make stainless steel. We're not going to run out of nickel to make stainless steel or even electric vehicle batteries in the next couple of years. The issue, what you've got is the LME is where class 1 nickel is traded, which admittedly is a fairly tight market. But class 2 nickel, as you can see over here on the right-hand side, trades at a very large discount to class 1, which is suggesting that nickel on the whole is actually fairly well supplied. And for that reason, I think we'll see clear heads prevail, markets to kind of stabilize a bit, and hopefully these short squeezes to be a thing of the past as we roll through 2023.